Good morning. Today, we're diving into a high-stakes trade negotiation between the United States and South Korea, two major allies now at a critical impasse. Unlike typical trade disputes over cars or agriculture, this deadlock centers on currency policy and a massive investment package. Both sides are holding firm. The U.S. wants to secure a landmark deal, while South Korea is worried about the financial risks. The outcome could set a global precedent for how trade deals handle currency issues. This isn't just about economics. It's about the stability of a key alliance. As negotiators scramble for a breakthrough, the world is watching. Let's break down what's at stake and why this matters. At the heart of the talks is South Korea's pledge to invest $350 billion in the U.S., a staggering sum that has captured the attention of global markets and policymakers alike. This isn't just a headline number. It's a signal of deepening economic ties between two of the world's most advanced economies. The scale of this commitment is almost unprecedented, reflecting both ambition and trust. This isn't a loan. It's a sweeping commitment to build new factories, acquire American assets, and inject fresh capital directly into the U.S. economy. The investment will touch nearly every sector, from manufacturing and technology to finance and infrastructure. It's about creating a long-term partnership that goes beyond simple trade. For Washington, this is a clear win. Tens of thousands of new jobs, a boost to economic growth, and undeniable proof that the U.S. remains the world's top destination for foreign investment. It's a chance to revitalize communities, support small businesses, and strengthen America's position in the global economy. The money would flow into cutting-edge industries. Think new semiconductor plants rising in Texas, electric vehicle factories transforming the Midwest, and advanced manufacturing hubs springing up across the country. These investments are designed to future-proof the American economy, making it more competitive and resilient. But moving $350 billion out of South Korea and into the U.S. is a logistical and financial challenge of epic proportions. It requires careful coordination between banks, regulators, and governments on both sides of the Pacific. Every step must be meticulously planned to avoid market disruptions. The sheer scale of the investment dwarfs the annual output of many countries and puts immense pressure on South Korea's financial system. It's not just about finding the money. It's about ensuring stability at home while making such a massive commitment abroad. The U.S. sees this investment as the deal's cornerstone, a foundation for a new era of cooperation. But in Seoul, there are real concerns about the potential fallout. How will this affect South Korea's economy, its currency, and its own industries? The pressure is on to finalize a deal that both sides can claim as a victory. Negotiators are racing against the clock, balancing national interests, political pressures, and the expectations of global markets. But the mechanics of moving this much money are anything but simple. Every transfer, every approval, and every regulatory hurdle must be navigated with precision. Even a small misstep could have ripple effects across the world's financial system. That's where the trouble begins. The stakes are enormous, and the world is watching to see if this historic investment can truly deliver on its promise, or if the risks will overshadow the rewards. Why is there so much anxiety in Seoul right now? On the surface, it might seem like a straightforward business decision, just another international investment. But for South Korea, the stakes are much higher. The government, financial leaders, and even ordinary citizens are watching closely, aware that the outcome could shape the country's economic future for years to come. The real challenge isn't simply about making a large investment in the U.S., it's about how to actually pull it off without triggering a financial shock at home. Behind closed doors, officials are grappling with the logistics, the risks, and the potential fallout. To invest in the U.S., South Korea must convert vast amounts of won into dollars. This process would flood the currency market with won, putting immense downward pressure on its value. If the won drops sharply, it could set off a chain reaction, affecting everything from consumer prices to international confidence in the Korean economy. A weaker won means imports become more expensive, driving up the cost of everyday goods, fuel, food, electronics. Inflation could spike, squeezing household budgets and threatening the stability that South Koreans have worked hard to build. For families and businesses alike, the fear of runaway prices and economic uncertainty is very real. South Korea's financial institutions are not equipped to handle such a massive outflow of capital overnight. The proposed $350 billion investment package is far beyond their usual capacity, raising concerns about liquidity and the ability to maintain normal banking operations during the transition. That's why Seoul is demanding strong guarantees, mechanisms to prevent a sudden currency crisis. These could include phasing the investment over time or establishing a currency swap line with the US to ensure dollar liquidity. Such safeguards are essential to protect the Korean economy from shocks. Without these protections, the risk of market panic is very real. Investors could rush to sell off Korean assets, further weakening the won and deepening the crisis. The memory of past financial turmoil still lingers, making officials extra cautious. South Korea's message to the world is clear. We're willing to invest, but not at the expense of our own financial stability. The government is determined to protect its citizens and economy, even if it means delaying or renegotiating the deal. For this reason, Seoul is looking to Washington for help. U.S. cooperation is crucial to smoothing the process, whether through financial support, policy coordination, or diplomatic assurances. Until those guarantees are in place, Seoul is holding firm. The deal remains unsigned and the deadlock continues, leaving the future of this massive investment and South Korea's economic stability hanging in the balance. The South Korean won isn't a global reserve currency like the dollar or yen. Its market is smaller and more volatile. Big transactions can cause wild swings. Memories of the 1997 Asian financial crisis still haunt policymakers. South Korea's export-driven economy depends on a stable won. Sudden drops disrupt business and raise costs. The government's goal isn't a strong or weak currency, but a predictable one. That's why Seoul insists on special precautions for this deal. They want Washington to share responsibility for managing the risks. This difference in risk tolerance is why talks have stalled. When the U.S. recently announced a massive $550 billion investment deal with Japan, it was hailed as a landmark moment in global finance. The agreement signaled deep trust and a robust economic partnership between two of the world's largest economies. American officials, eager to replicate this success, naturally turned to South Korea, asking, "Why not strike a similar deal with us?" On the surface, it might seem like a logical next step. After all, South Korea is a close ally, a major trading partner, and a technological powerhouse in its own right. But when Washington posed the question, Seoul's response was clear. The comparison isn't fair, and the circumstances are fundamentally different. South Korea points out that its financial landscape is not a mirror image of Japan's. The Japanese yen is one of the world's most trusted reserve currencies, widely held by central banks and investors across the globe. Japan's financial markets are deep and highly liquid, able to absorb enormous transactions without destabilizing the system. On top of that, Japan boasts massive foreign reserves, providing a powerful safety net in times of crisis. And crucially, Japan enjoys a permanent currency swap line with the U.S. Federal Reserve, an extra layer of protection that reassures global markets and investors. South Korea, by contrast, lacks these financial buffers. Its currency, the won, is not widely used or held outside its borders. The won is more vulnerable to sudden swings and external shocks, making it riskier in the eyes of global investors. South Korea's foreign reserves, while significant, are much smaller than Japan's, offering less of a cushion in turbulent times. Forcing Seoul to match Japan's deal without similar safeguards would expose the country to unnecessary financial risk, a move that could backfire for both sides. South Korea isn't refusing to invest or cooperate. Instead, it's asking for its unique vulnerabilities to be acknowledged and addressed in any future agreement. The US-Japan template simply doesn't fit the South Korean context, and trying to force it could undermine the very partnership both sides value. That's the heart of Seoul's argument. South Korea wants to build a strong, sustainable partnership with the US, but only if its distinct financial realities are respected. The US-Japan deal set a precedent, but the context was different. Japan's economy is stable, its financial system mature, and a weaker yen isn't a threat. South Korea faces more volatility, higher inflation risks, and a history of external shocks. What works for Tokyo could spell disaster for Seoul. US negotiators want to replicate the Japan model, but South Korea needs a tailored approach. A one-size-fits-all deal ignores the realities of each country's financial system. Seoul is pushing for an agreement that fits its circumstances, not just a copy of Japan's. That's why the talks remain stuck. The won's recent roller coaster explains Seoul's caution. After years of weakening, the won hit 15-year lows in 2024, then rebounded sharply in 2025. This volatility makes policymakers nervous about any shock to the system. Injecting a $350 billion outflow could trigger unpredictable swings, either a surge or a collapse. South Korea's balancing act is delicate. The wrong move could destabilize the economy. The government isn't being difficult, it's being prudent. Without explicit safeguards, the risk is too great. That's why Seoul is holding firm. The US wants a quick, clean deal. $350 billion in investment, no strings attached. For Washington, the details of how South Korea manages the outflow are Seoul's problem. The US sees this as a model for future trade deals and wants to move fast. South Korea, meanwhile, is focused on financial stability. They want explicit safeguards, phased investments, currency support, and risk management built into the agreement. For Seoul, signing as is would be reckless. Finance Minister Koo Yoon-cheol has made it clear, currency protections are non-negotiable. South Korea wants a partnership, not just a pledge. The deadlock is about more than money. It's about trust and responsibility. Until both sides align, the deal is on ice. The US-South Korea trade talks are stuck on one issue: how to manage the currency fallout from a $350 billion investment. South Korea wants safeguards. The US wants speed. The comparison to Japan's deal is misleading. Seoul's risks are real and different. A compromise could mean phasing the investment or creating a temporary currency swap line. For the US, this is a test of modern trade diplomacy. For South Korea, it's about protecting economic stability. The outcome will set a precedent for future global deals. Success could strengthen an alliance and reshape trade negotiations worldwide. The world is watching to see if these two allies can bridge the gap.